Good morning and welcome to the Morning Bell. I'm Robert, joined as always by Lizzie and Steve. It's Tuesday, July 14th, and we've got a big one today. A cooler than expected June CPI print is lighting up futures. IBM is having one of its worst days in nearly 40 years, and bank earnings are coming in mixed. Plus, we'll get into what's moving crypto. Let's get straight into it. Lizzie, Nasdaq futures are up 1.3% on this inflation surprise. How are you positioning this morning?
Morning, Robert. The CPI print is the dominant catalyst right now, and the market's response is pretty clear. Growth and tech names are leading the charge in the pre-market, which makes sense given that softer inflation reduces pressure on the Fed to stay restrictive for longer. From a positioning standpoint, traders are rotating into rate-sensitive sectors like tech and real estate, and the broader sentiment shift is meaningful because it follows weeks of macro uncertainty driven by Iran tensions and rate hike fears under Warsh. The key question today isn't just whether the rally holds at the open, but whether Fed Chair Warsh's testimony this afternoon reinforces or contradicts what the data is telling us. At 3.75% on the funds rate, even a slightly dovish signal from him could extend this move significantly, while any hawkish surprise would cap the gains quickly.
IBM is down 23% today on an infrastructure miss. Is this a company-specific story, or does it say something broader about enterprise tech?
It's primarily company-specific, but there's a spillover effect worth watching. Accenture, ServiceNow, Workday, and Salesforce all slipped in sympathy, which tells you the market is at least asking the question about enterprise IT spending cycles broadly. CEO Arvind Krishna said the infrastructure results were worse than our expectations, which is a significant admission, and the stock is on track for its worst single day in nearly 40 years, so this isn't a minor miss. For traders, the more actionable read here is to treat IBM as isolated, until we see whether any of those peer names report similar infrastructure weakness in their own upcoming results. If it's contained to IBM, the dip in the others may actually present an opportunity.
On the other end of the spectrum, Citigroup posted a 45% profit jump. How do you read the bank earnings picture so far?
Citigroup's numbers were genuinely strong. $5.8 billion in profit, EPS of $3.05 against a $2.74 estimate, and revenue of $24.8 billion, topping the $23 billion consensus. So that's a broad-based beat across the board. The nuance, though, is that JP Morgan slipped 1.7%, despite beating estimates because gains were attributed to one-off investment items. And Bank of America eased slightly, even with a 27% profit jump, which suggests the market came in with very high expectations, and is now scrutinizing the quality of earnings rather than just the headline numbers. The KBE Bank ETF is up 12.4% year-to-date, so a fair chunk of the good news was priced in. And the real test will be whether Morgan Stanley and the remaining names reporting tomorrow can sustain the narrative.
Tower Semiconductor is surging nearly 19% pre-market on a $3 billion Japan expansion backed by government grants. Tradable move?
It's a real catalyst, and the numbers are significant. A $3 billion expansion with $1 billion in government backing is not a small deal, and the semiconductor supply chain theme remains one of the strongest structural stories in the market right now. The geopolitical angle actually works in Tower's favour here rather than against it, because government-backed semiconductor manufacturing in allied nations is precisely the kind of policy tailwind investors want to see in this space. That said, after a 19% gap up in the pre-market, disciplined traders would want to wait for the open and see where price stabilises before chasing. Buying into that kind of gap without a clear entry level is how you get caught in the reversal.
What about Palo Alto Networks, up 95% in 3 months, sitting 59% above its 200-day moving average at 86 times forward earnings? Is this a momentum trade or a concentration risk?
Both, honestly, and that's the challenge. PANW has been one of the strongest momentum names in the market, and the cybersecurity thesis is solid. But at 86 times forward earnings and 59% above the 200-day, the valuation leaves almost no room for any execution miss whatsoever. The concentration risk angle is the one most investors are missing. It appears in 54 different equity ETFs, with IGV holding it at over 10%, and a reversion to the 200-day alone would imply roughly a 37% price drop, which would create a meaningful drag on IGV and other funds. Investors who think they're diversified through broad tech ETFs may be carrying far more PANW exposure than they realise, so it's worth checking your actual holdings before assuming this is a straightforward long.
Steve, the CPI print dropped this morning. Walk us through the actual numbers and what cooled.
Today's June CPI release is the marquee data point of the week, and the market reaction speaks for itself in terms of how significant it was relative to expectations. The prior reading for May came in at 335.12, essentially matching the forecast of 335.111. So inflation had been running close to expectations. The June print coming in softer than that prior level is what's generating the enthusiasm you're seeing in futures this morning. The cooling appears broad-based rather than driven by a single volatile category, which gives it more credibility as a genuine disinflationary signal rather than a one-month anomaly. And it directly supports the case for the Fed to hold or potentially move toward cuts later this year.
And what about the labour market picture? June NFP came in at just 57,000 against a 110,000 forecast. Does that give the Fed more cover to cut, or is it starting to look concerning?
The June NFP number released on July 2nd was genuinely weak. 57,000 jobs added against a consensus of 110,000 and a prior reading of 129,000. So the deceleration in hiring is a consistent trend rather than a single data point outlier. ADP for June also came in at 98,000 against a forecast of 113,000 and a prior of 122,000, which reinforces the softening picture across both public and private payroll measures. Taken together with a cooling CPI, the dual mandate is moving in the direction the Fed needs to justify easing, but the pace of labor market deterioration is fast enough that some analysts will start asking whether this is a controlled slowdown or something the Fed needs to get ahead of more urgently. Tomorrow's PPI release for June will be another important data point, with the prior reading sitting at 1.1%, and May having already surprised to the upside against a 0.7% forecast.
What are the key releases traders should be watching for the rest of the week?
Thursday brings two important releases simultaneously: retail sales for June and initial jobless claims, both at 8:30 a.m. Eastern. Retail sales came in at 0.9% for May, well ahead of the 0% forecast, so the bar is elevated and any meaningful miss would reinforce the softening consumer narrative. Jobless claims are expected around 219,000 based on the prior week's forecast level, and given the weak NFP print, any upside surprise in claims would amplify concern about labor market momentum. Then on Friday, we get the Consumer Confidence Index for July from the Conference Board, University of Michigan Consumer Sentiment, housing starts for June, which previously came in at 1.177 million, well below the 1.43 million forecast, and industrial production, making Friday one of the heavier data days of the week for macro watchers.
Lizzie, let's get into crypto. Bitcoin is holding near $64,000 and Ethereum is up nearly 6% today. What's driving the resilience given the macro headwinds?
Bitcoin is trading around $63,845, up about 2% on the day, and the resilience here is largely a function of the same CPI print that's lifting equities. Softer inflation reduces the probability of additional rate hikes under wash, which directly relieves pressure on liquidity-sensitive assets like crypto. It's worth noting that just yesterday, Bitcoin was at $62,049 and Solana was at $74,087 after a sharp sell-off driven by the US-Iran tension, reigniting oil and inflation fears. So the bounce today is meaningful, but it's recovering losses rather than breaking new ground. The return of spot Bitcoin ETF inflows after an 8-week drought is a constructive institutional signal. The iShares Bitcoin Trust saw $86.8 million in inflows late last week. And that kind of institutional participation tends to provide a more durable floor than retail-driven momentum.
XRP whales scooped up 900 million tokens in 48 hours on ETF approval buzz from CBOE, Nasdaq, and NYSE. Real catalyst, or getting ahead of the regulatory timeline?
The structural catalyst is real. CBOE, Nasdaq, and NYSE filing coordinated exchange rules in July to establish a standardized crypto ETF framework is a genuinely significant regulatory development, and BlackRock's potential iShares XRP trust launch under that framework would be a major institutional signal for the asset. XRP rebounded 3.18% to $295 on the back of this activity, and 900 million tokens accumulated in 48 hours is the largest whale accumulation since June 2025, so there's clear conviction money moving in. The risk is the regulatory timeline. Approvals can take longer than markets anticipate, and sentiment can reverse quickly if there's any pushback from the SEC. So while the directional setup is constructive, position sizing matters here because the gap between ETF buzz and actual approval can be wide and volatile. Ethereum is also worth noting, up 5.74% to $1,183 today, and DeFi tokens broadly are showing strength with CRV, LDO, and ENA all up significantly, suggesting this isn't just an XRP story, but a broader risk-on rotation into the crypto space.
That wraps up today's Morning Bell. Remember, this is not investment advice. Do your own research. And don't forget to subscribe so you never miss a morning. See you tomorrow.